Hello and welcome to this latest edition of Courses on Demand brought to you by Forex.Academy. In this course, we'll be discussing trading ranging markets. There is, of course, inherent risk when trading the financial markets, so just before we do begin, please take a moment to familiarize yourself with the following disclaimer. Now, in focusing our attention to trading ranging markets, we'll first need to address the question, what is a range-bound market? So let's define a range-bound market in terms of its price structure and why it's different from trending markets. We will then look at some range trading opportunities and discuss some of the potential risks that actually deciding to trade these ranges pose. We'll then look at some technical analysis in terms of the technical setups that we see that help define ranges and help define those trading opportunities. And then we'll discuss expectation theory. And there is an added element, I suppose, of psychological trading when deciding to trade these ranges, given that fear and greed does come in to the range trading exercise indeed. And then that'll finish off nicely with price stability. Many analysts do believe, and traders alike do believe, that because markets decide to trade ranges, there's an element of stability there. In some cases, it's certainly the case. In other cases, it's most certainly not. As well as that, we'll discuss some fundamental scenarios where fundamental institutions decide to manipulate the markets, perhaps in government intervention or central bank control, and that can often lead to price stability in many assets as well. So first and foremost, let us define what a range-bound market is exactly. Well, a range-bound market is one in which price bounces in between a specific high price and a low price. The high price acts as a major resistance level in which price cannot seem to break through, and as well, the low price acts as a major support level in which price cannot seem to break through. So let us picture that, for example, we have a range starting to trade, it's trading horizontally sideways, and we see a level of support below and a level of resistance high. Two lines that perhaps give us an element that the market will certainly trade between this range, and we can use these support and resistance levels to bounce off. Market movement could be classified as trading horizontally or perhaps sideways. So let's look at this in terms of price structure. The market can often find a range in which it will trade after a large price move. So here on the left we see, now this is the euro pound. We see a very volatile sharp move to the downside. And then with our green arrow we see a level of recovery, a level of stability that perhaps comes into the market. And then we see the range ensue. Where do the opportunities lie? Well, within these green bands, we can see trading opportunities exist when the market reaches the top and bottom of the range. Why do financial markets often trade in range? Well, financial markets, they very rarely trade in a linear fashion. Now, that means they do not trade very often in a straight line upward fashion. We see volatility in the markets more often than not. And they'll always experience a level of volatility that will move asset prices both up and down. As economic performance coincides with current daily news events, this volatility causes change in price that lead to price shocks and swift movement in the asset price. We often see this as technical traders as breakouts. However, markets do not break out all the time, and after experiencing price shocks, markets often find some price stability. The new price stability can form a trading range at the new higher or lower price of the market. So there is a market shift perhaps to the upside with some volatility. Once that volatility comes out of the market, we see price stability feed into the market sentiment, and then slight volatility will cause a trading range. More generally, technical traders observe financial markets as they break out, find a new range, break out from that range, and so forth. Such is the movement of price. So here we have a fairly constructive range. Now, what I want to point out that even though we often see ranges trade in a horizontal or sideways fashion, it's not always the case. So what we have here is a very constructive price channel to the upside where range conforms to trading within the price channel itself. It's a very clear trend, but it allows us opportunities, perhaps more opportunities on the buy side given the range. Range trading, it's a simple approach to price speculation. We aim to buy the low of the range and sell the highs of such price action. So here, as discussed, we have a range. Where are the range trading opportunities? Well, we can see that we have high and low range trading opportunities, which are very well structured in terms of risk. We know that we're going to be correct if we perhaps decide, and I'll just use my epic pen, if we decide to sell the market here on the downside and the market trades up, we know that the range is broken and that we're going to take a loser. Perhaps there is often times when there's a false breakout and it causes a range little structure above our channel that can often feed into the fear that we have of taking a loser, but you can see it often can come back in and conform to the range again. So plenty of range trading opportunities within this price channel, and you can see it's not trading horizontally, it's actually trading in an upwards fashion, but still able to provide those range trading opportunities. Here we have another chart. We have the euro US dollar. We're looking and observing 1 hour price patterns. So each of these Japanese candlesticks represent 1 hour. What we can see here is some very constructive price action indeed, yet we see a level of volatility. So where again are the range trading opportunities? Well, we see in our green band areas that we have less volatility, albeit within different structures of range trading opportunities. The market tends to range, break out, find a new range, break out. So always be aware when deciding to look for these range trading opportunities that as the range becomes more mature, there's a higher probability of a breakout either to the upside or downside. You don't know when that can happen, but it certainly will occur at some stage. We are never sure how long or exactly how volatile the range will be. So you can see we have these 4 constructive price ranges here, and they see some volatility. They each share different levels of time of the actual price range itself. Looking at some risks, there are some inherent risks when deciding to trade these ranges. Range trading assumes that markets must trade in a particular fashion. So there is an assumption there that the market must trade in a similar fashion. It must conform to the range. It must either trade sideways if the range is trading sideways, or it must either trade according to a price channel within a range. So a certain structure needs to come into play. Traders often believe ranges are a reflection of stability when it can often be low volatility. So that's not necessarily the case. Just because it's trading within a range, it's not necessarily a reflection of price stability. It could just be low volatility. Prices will inevitably break out from the range, and market participants often make money trading the range several times. They often think it's the free money trade. Look how many times I have been buying and selling the highs and lows of the range. And then they overcompensate for that risk when they perhaps make the 4th trade, and inevitably that turns out to be the loser. So they can often lose big when they decide to overcompensate on their risk. Let's look at some technical analysis. Now, using technical tools as a technical indicator will help stack the odds in your favor. But in particular, when observing and discussing trading range in markets, we have some indicators that can give us a little clue, a little indication to whether these ranges form and how good or well structured they will be. Bollinger Bands is a good example. They contract when there is less volatility in the market and expand when there is more volatility. Because of that, Bollinger Bands provide a good tool for breakout strategies. When the bands are thin and contracted, volatility is low and there should be little movement of price in one direction. Okay. When the bands start to expand, volatility is increasing and movement of price in one direction is more probable. Generally speaking, range trading environments will contain somewhat narrow bands compared to wide bands and form horizontally. By buying near the low price, the trader is hoping to take profit around the high price, and adversely, by selling near the high price again, the trader is hoping to make profit around the low price. So here we have the Euro US dollar again. We're observing a 1 hour price pattern. Again, we can see our Bollinger Bands stretching across and following the price action and really dictating to us the level of volatility that that price action is suggesting. Here when we have our levels of high volatility, we can see the band is expanding with and in conjunction with high volatility. In terms of looking for range trading opportunities, that would negate those opportunities and suggest that we should not be trading or looking to trade any range within these areas. When we see our areas of green volatility, that would say there's low volatility in the range here, and the band, as you can see, they're contracting. So I'll just use my Epic pen. We'll use blue here just to follow the Bollinger Bands. We can see these levels here, particularly starting to show very thin contraction of the bands. Here, as the market leaves this volatility, we can see the contraction of the bands are quite thin and quite close to the price. That would tell us that for a period of time, there's going to be market ranging. Here again, we see a very, very large level of volatility. As it settles down here, we see the levels contract and conform to the price structure, showing us that there's going to be a certain level of range trading or low volatility with that contraction. Looking at another technical indicator, it is within the relative strength index or RSI where we can find some very good technical indications indeed. The relative strength index attempts to technically define whether the market is overbought or oversold. The indicator ranges values from 1 to 100, whereby over 70 is regarded as overbought and below 30 is regarded as oversold. Prices are said to be exhausting when the market trades above and below these ranges. The relative strength index can be used to trade ranging markets where periods of price exhaustion coincide with the high or low of the range. So we use this in conjunction, this technical indicator, we use it alongside judging and observing the technical price action to look for these trading opportunities. Let's observe this within a price chart. And here we have on screen the Euro US dollar observing a 4 hour price charting candlestick pattern. What we have here is our very significant levels of support and resistance. And you can see here that the range is very much conforming to it, albeit there are some levels of breakout opportunity, false breakouts within the price structure itself. To signify our very important levels of price exhaustion, we have here 70 and 30. So when there are areas when the price perhaps here and here signifies to trade below or above these areas, we can say that the market has moved across or is overbought or oversold, and prices begin to exhaust and look to reverse from these levels. That and such is the indication of the relative strength index. So let's move on with the charting and see if we can identify some possible trading opportunities. Here we have some significant levels where the relative strength index has pointed out to us where price may look to bounce or reverse off our levels. And what we need to do is actually coincide where we're at in terms of the actual indicator level and the market structure itself. So to name but a few examples, we can see we have plenty of examples here across the 4 hour chart pattern. Just when we observe the price action, what we can do is point out some levels of interest for us where we would perhaps like to trade these opportunities. So here we have many opportunities, both high and low, where we're looking to either buy or sell, bouncing from the range to actually look to identify these trading opportunities should prices stabilize and allow us good trading opportunities within. Now, how does that coincide with our relative strength index? Well, what we look to do is see where the prices touch our actual level of exhaustion, and if we can actually get a trade-off, that will let us know that the price action coincides with the indicator signal itself. Let's highlight a few of these opportunities. Here we have one here where the price action is almost at highs, and we'd be looking to sell around this area. So for us, that would be a technical setup to actually take a trade position. Here as well, we have some very high price action at our significant level of support, and that would be almost within our level. So just a little below. If it was a little bit higher in terms of the relative strength index, those would be the perfect opportunities. Here we have a very constructive level in terms of the relative strength index, but we can see here that the price is consolidating in the middle of the range, and that does not provide us with a trading opportunity. Here as the market reverses from the highs, where we have a very constructive level to actually sell the market at a level of support and resistance, and it is very well conformed in terms of providing a proficient signal with that relative strength index. So as we move across the markets, we can see various points. Perhaps here is a very significant one where we're right above, just touching our high, providing us with a perfect sell opportunity, and adversely we get the downward structure straight away, providing us with a very significant trade to the upside again. So as we look across the 4-hour chart pattern using a relative strength index in conjunction with our knowledge of price action and technical indication, we can see that using it together provides us with opportunities. So let's just rehearse these opportunities. We can see that that does not provide us with a signal given where the relative strength index is. Perhaps this is just a little below the relative strength index, but again providing us with a good sell signal to the price action. We can see below here we get a very constructive bounce from our level of support and resistance in conjunction and in tandem with the relative strength index. Here we have almost a false signal, just given the price action is supportive. However, we can see that just below we don't have the most constructive relative strength indicator at all here within this region. And again here we have perhaps a very prolific buy signal as well. Why? Well, because it's very conformative in terms of using the technical indicator to support your trading decision to the upside from the level of support and resistance. And we see the market bounces and is actually quite strong and constructive from such an area. Now, it should be noted as well that as we can see and observe the price chart, do not forget that prices will always eventually break from the range. Now, these are inevitably false breakouts. They don't show continued price movement in that direction. But in terms of actually trading these markets, if you were to take a trade in and around some of these areas here, do note that you must have your stop losses in place, because that in itself would almost be a one-to-one loser in terms of risk reward to the upside. And we don't know that that will be the low of this market. Prices could continue to the downside. So there is that extra element as you trade these ranges of risk, should you become overcompensating with that risk and allow greed into your trading. But we'll talk about that with expectation theory. That leads us on, I believe, to the theory itself. Let's discuss it in some more detail. Expectation theory has everything to do with deciding to trade the financial markets. So this is not just, guys, this is not just deciding to trade the ranges. It has everything to do with trading and all walks of business and life. In the same way, new business owners have expectations on revenue, financial traders have expectations as to how much money they will make. And it's significant for us as financial traders because our level of success really is totally indicative of the amount of money we actually make in the markets. Financial trading is all about deriving an expectation on future price movement, placing those trades, and deciding whether the profit made in those trades have met your expectation for the trade. Why is this so important when discussing range trading? Well, because range traders must accept to limit their expectations on movement and hence profit. Such a very important point to make with expectation theory in terms of range trading, guys. We must accept to limit our expectations on price movement. Why? Because we're not trying to trade a big breakout trade or a long-term price structure. We're looking for short-term price profits within a range from high to low or from low to high. If we can get one or two or even three of these trades off within a range for profit, that's fantastic. We should not overcompensate or increase our expectation for profit on one particular trade. That leads us into discussing fear and greed. Although all financial trading must assume risk in order to profit, range trading styles often take on an extra human element to your trading decision making. It is the belief that as markets begin to trade in a range and thus find some short-term price stability, there is an element of safety in this trading environment and the trade decision. This causes many traders to trade more frequently and to take on more risk, and this certainly leads you to become a little greedy in the markets. Now, I would say greed can be a positive thing when you are looking to, increase your exposure to a trade that is performing well. It's not necessarily greed, but in terms of range trading markets, remember our expectations are limited, and this does not agree with our potential greed for market trading. Whether prices seek a new breakout and/or certain news events cause volatility, prices are certain to trade away from that range after a period of price consolidation. It is at these moments fear begins to affect the range trader, as they often made money throughout the life of the range and are now overcompensating with risk. So let's perhaps look at a physical example here in the market to outline how this could affect our trading and obviously lead to a negative effect on our account balance, which is not something we want. Here we have crude oil, and we see a very, very constructive range forming in and around the $52 to $54.30 mark. Very constructive indeed, and it's over a long time period as well. So that would lead us to make many trades. Can you see how trading the range evokes this added element of risk? We see the breakout to the upside, then we see the constructive trading range. Then we can see that we can get many, many positive buys and sells, albeit with some volatility throughout the range. My question I would like to pose is, what happens here? Not specifically what happens with the market, but in terms of your trading, if you've made 4 of these very good trades and the market decides to trade back down to a level, and if we look at our price action here, it actually hasn't come to the level for quite some time considering the range. So we've been waiting, and we've got the sell trade here perhaps. We've been waiting to look for the market to come back down to a range where we place our next order. What does happen here, guys? Well, we decide that perhaps even here we've made a 2% trade as opposed to 1% trade. For other markets, often traders will then overcompensate, considering they've had maybe 1, 2, 3, 4 good trades. Evidently, the market has come back down to our price point. Let's go for a 3% trade. And obviously, we see the breakout to the downside where the loser takes place. So risk is so important in terms of remaining remaining constructive and remaining standardized in terms of a risk. Objective is the word I was looking for in terms of approaching risk and allowing allowing yourself to make those consistent profits where ranges form, as opposed to doubling up, and then taking a big loser. That would be more conducive towards gambling with your trading, which is not something we want to recommend, of course. So we see the breakout to the downside. We've answered the question, what happens here? And we see that often many traders can induce and put much more risk involved in that last fatal trading decision. The key, I suppose, is to limit the fear factor by not being too greedy in not taking too much risk via range trading. Moving on, let's have a look at price stability. What we mean by that fundamentally is that there are often scenarios where this can occur in the markets. Government influence may be one. So government influence of monetary policy aims to target inflation at 2% year on year. This is a fundamental factor of actually trying to run the economy. This effort is aimed at price stability. However, there are many constructive scenarios where the markets signal collective attempts for price stability and over many different asset classes. Now, these perhaps could allow some trading opportunities, and obviously there is an added element of risk to these trading opportunities. We see the oil market has seen some price stability, and that is obviously to stop the oil price slide or decline over the last year, 2 years. What we see is OPEC production cuts, and it's a fundamental discussion to actually stabilize prices. So when we look back at our oil example, we can see that there was a long-term level of price stability there around $50. and that was very much a fundamental discussion between OPEC and its earlier production cuts. The bond markets, well, how can the bond markets be manipulated in terms of trying to add price stability? Well, it is the government itself which controls the supply of bonds into the markets by issuing debt, and that they can also have effect on actually stabilizing the yield, which will have a reflective, exact, direct reflection on the price of the bond itself. And that can also lead us into the forex currency markets, where government and central bank intervention can actually decide to manipulate the forex currency markets, which we've seen many periods through the last 50 years, where either the S&P or the Bretton Woods example there in the UK, where they have actually intervened in the currency markets and able to allow some price stability with their currency in relation to others. And commodities, of course, we see many countries introduce trade tariffs to conform to a certain level of price for a particular commodity, so that there's no really difference in the import-export formula. As prices start to see some extra volatility, we see governments introduce tariffs to control that price volatility. So those four examples are some very constructive fundamental scenarios where we see large institutions, perhaps, or bodies, or governments even, come into the markets fundamentally to look for price stability. Now, in actually looking technically, that can actually add and allow some opportunity in the markets. Here we have a case study, which I did mention, central bank intervention. The Swiss National Bank. The Swiss National Bank had made a mandate for domestic currency stability for the CHF, or the Swiss currency, given that Switzerland was such an important trade partner in the Eurozone. It was vitally important to keep the domestic currency competitive with the euro. So the mandate was focused, guys, on pegging the Swiss franc throughout 2014, the whole way to 2016, capping it at euro to 120. So this is a direct signal to the markets, paving the way for trade trading opportunities. So what we have here is the Swiss National Bank, the central bank, saying to the markets openly, directing to the markets that we want to keep the Swiss franc pegged in and around 120 for the euro. So what would you do if you're looking to trade these opportunities? Well, if there's a big price increase or decrease away from 120, you'd be looking to fade these moves. Now, what we see is a long-term price structure in and around the 120 to 122 mark, where we see range trading going for such a long period of time. However, a point I would like to make is when trading the financial markets, when range trading, I suppose, in particular, there is always a lesson to be learned. So here we have really a groundbreaking news event when the Swiss National Bank decided to actually remove the peg from the euro, and we see the currency devalue itself from 120 the whole way to almost par with the euro just below, as we see the market spike at 99.98 levels. The point being that we have a long-term price stability capping the euro for such a long time. So that would provide us with trading opportunity here. Now, I want to point out that this isn't conducive of actually trying to buy and sell these lows, these highs and lows here within the markets. This is just to give you an idea. This is over a very long time period, from 2014 January the whole way to 2015, that we see here. This market would have allowed trading very finer trading opportunities, range trading opportunities within such a long period of time, the whole way across this range, as you can see. So very constructive fundamental setup for maybe a 1.5 year period that allowed range trading, but evidently there is a lesson to be learned. It was a shock to the market at the time, and we see inevitably a very strong breakout to the downside. Again, what I'd like to reiterate is there's nothing wrong. This area here provides 1.5 year of trading opportunity. So get involved in these range trading opportunities when they arise, but know that there is a risk involved if there's going to be a breakout either to the upside or to the downside, which we see an extensive one. So never overcompensate too much on your risk. Try and understand the fear and greed factors of range trading scenarios. Allow yourself the opportunity to buy and sell the lows when the markets continue to formulate to the strategy itself. But when that strategy breaks down, be happy to take your loser and keep your risk management in sight. So that concludes our study on trading range in markets. What did we learn through the webinar? Well, we discussed what a range bound market is. We discussed range trading and looked at many different range trading opportunities and setups. They can both either trade horizontally or sideways, or perhaps in price structures like price channels to the upside or downside. We can see that there are added elements of risk to range trading, particularly the emotional side or the psychological state with fear and greed. And that leads us on to the technical analysis while describing expectation theory. We have some very good technical indicators, the RSI or relative strength index, and of course we have our Bollinger Bands which contract and can show you areas of low volatility where those ranges perhaps can form in the markets. And again, it is often a belief that because the market trades a range, it offers some price stability. That's a bit of a fallacy in the financial markets. From a fundamental scenario, it can happen as institutions and organizations like OPEC will maybe come into the market and really dictate price stability. But always look at the technical setup to see how that conforms using the technical indicators without adding too much risk to your trading to make the best out of these opportunities within the financial markets, guys. So that concludes our webinar for trading ranging markets. Thank you very much for joining us on this installment of Courses on Demand by Forex Academy. We do hope to see you very soon. Bye for now.